Hey everyone, so glad that you could get on this webinar. Sorry, we're starting a few minutes late. Had a couple of technical difficulties, but we're up and running and we're getting going. So here, yeah, thanks for coming to webinar number 2. Thankful for everybody who's on here and for any of you who will watch the replay as well. Hopefully these are helpful for you and just further understanding the markets and then slowly working through some behavioral finance stuff as well to just get, always become a more confident investor. So that's what the goal is with these webinars. So today we're going to talk about market update and budgeting, and then we are going to go through some budgeting things and give you some tips on how to set and stick to a budget. So who is Selah? We'll always start here. Selah was founded in 2019 with the goal of bringing confidence and organization to people's financial life through education, stewardship, and empowering wise decision-making. A holistic wealth management firm located in Southern California, but serving clients nationwide. For me, for my clients, my biggest thing is client mindset and look for clients who are disciplined in their finances, who are wanting to learn about investing and kind of more partner with me in their investments rather than just have someone just tell them exactly what to do. So that is who Selah serves. The goals of today are always to have a better understanding of the current markets. Today specifically, we're going to walk away, hopefully you can walk away with some budgeting tips that you can implement into your monthly budget and just to become a more confident investor. Again, that's always the goal with Selah, and so that you're going to see that on here pretty much with every webinar. If you have any questions as we're going through the webinar, feel free to text my text line 949-942-8805, and then I can answer those at the end, or if I don't get to them at the end, just for timing purposes, I will either get back to you personally or I will get back to you personally, but I also will take, I like to get kind of questions see if a lot of clients and prospects are asking the same questions, and then we can do future webinars on that information as well. So maybe one or the other may get answered on here at the end, but for time's sake, it may be personal or in a future webinar. So market update, we're going to go through a quick look. We want to talk about recovery of bear markets. And again, we're going to talk about recession. We'll probably be talking about that for the next little while. As possible, impending recession is coming. And so anyways, those are what we're going to be talking about today. So first here, let me get my screen out of the way so we can see this better. Quick look. So here's the chart that I like to start with when we're talking about the markets. Gives you, obviously year to date, 1 month and week ending. This is as of last Friday. Market had a really good week last week. You see the S&P 500 is year to date up 9.16% and the NASDAQ up 17.13%, like we talked about last time, but for anybody new. The reason the NASDAQ is higher, you'll see farther down in that S&P 500 index sector as well. Information technology. The NASDAQ is very heavy tech, and so tech had a really rough year last year. It was down more than most sectors, and so it's had a better start to the year so far this year. So that's why you see that NASDAQ is higher than that S&P 500, and then the Dow Jones obviously there as well. Those are indexes. Those are a collection of companies within those. For anybody who doesn't understand what the S&P 500 is, it is 500 companies on the S&P, and so that is getting the that year-to-date return is looking at those 500 companies. So the Dow Jones is 30. Like I said, NASDAQ is very heavy tech. So those are all going to look a little bit different, but they give you kind of a broad understanding of how the markets are moving. You can see, again, you can look at those sectors, see how different sectors are doing. Obviously, financials have had a rough start to year-to-date with just banking. Crisis, if you want to call it, but just all the banking information that's happened. So that's where you see that with financials. But you can look through through those sectors and see, kind of what everything is doing. Get a good look there. So, bear market lows. Like I said, we've been in a bear market for since the beginning of last year. So technically it started in January of last year. That's when the market first started going down. A reminder that a bear market is a market that has a lot, it's come off its high of 20%. So it has a decline of 20% or more. That gives you a bear market. So we have been in a bear market since, like I said, January of last year. We don't know for sure if the bottom is this October date, but that is the bottom so far, 10/12/2022. That is when we had, kind of a bottom in June and then again in the fall. And so October 12th, 2022 was that second bottom, was obviously lower than the June low. And we are 6 months past that. So this chart kind of gives you the S&P 500 index gain at 3 months after bear market low. So what the bear market low was, in those bear markets, 3 months after it, 6 months after, and 12 months after it. Again, like I said, there's an asterisk next to 10/12/2022 because it is not known if whether a new bull market has begun. We will not know if that's the low until we gain 20% off of that low, which we're not there yet. So that has not been a confirmed low, but that's just what we're working with right now because it's what we have. Currently, at 6 months, we sit 15.1% off that low in October, which is one of the weakest on this chart. So if you look through that chart, there are not many that are weaker than that 15% low. Average is 25%, 6 months off the low. So we're a good chunk below that, 10% below that. That's a good amount. And you can see on there are ones that are much, much higher. Obviously that 3 months and that 6 months. So we don't know the 12 months yet. We'll know in this fall, but we're hopeful that kind of weak start in this first 6 months since that low means that stocks have a lot of catch up to play. And so that maybe that will increase some gains that we see throughout the rest of the year. Obviously that's, probably a more hopeful outlook, but that's what we're hoping that means. That slow start means that there's going to be some catch up going here and with stocks. Less appealing scenario is we still have a second half recession and it drags stocks below that 2022 low. So that maybe if that low of October is not the low, then, and we do have a recession that comes in the second half of this year, that it does drag to a further low. And then we kind of start all over. That is not the base case, but if that does happen, it is thought that recovery off those new lows are thought to be very quick and swift. So it hasn't been a good recovery so far, or at least it's been one of the weakest so far. So that does lead us to believe that one, they're going to play catch up. That's one option. Or two, if we do hit a new low, that off of those new lows, this market will turn around pretty quickly and you'll have some swift and quick returns off and recovery off a new low. Here is, this chart is S&P 500 past growth scares and bear markets. So this is giving you some other, you can see on here, you got Black Monday, you got Gulf War, you got Asian monetary crisis, tech bubble, financial crisis, trade war, COVID-19 sell-off. So it's giving you some different market scenarios and growth scares that have happened within the market. And then it's giving you what it did the next 12 months after. So, you see some obviously pretty big declines and then what it did 12 months after. Just showing you that stocks have historically staged really strong rebounds coming out of bear markets, especially big growth scare bear markets. And so, everything is cyclical. The stock market is cyclical. It is seasonal. And so we know that we hit highs and then we're back in the cycle of, coming back down in a trough recession. And then after that, there's growth again. So, again, it's all about perspective. We talked about that a lot in the last webinar. Your perspective can be, shoot, we're in a bear market. We're going to recession. It's all bad news. It's all bad news. Or your perspective can be, great, this is winter. Spring will come. We know what's next. Perfect. Let's get money in and let's keep investing. So again, all about perspective. This I thought was an interesting chart that I wanted to share with you guys and show you kind of just what's going on here. But the VIX is at its lowest in its recent downturn. It's at its lowest high. But interestingly, the VIX, okay, so let me back up for a second. The VIX is the volatility index that most people watch very closely in when markets are volatile, it just kind of is a fear index. It's kind of known as the fear index. So when that goes up, it means that fear is rising, volatility is rising, people don't have good feelings about the market. When that comes down, that means fear is falling, volatility is falling, people are feeling better about the market. So that is what the VIX index is, the volatility index. So normally you can see the highs of this VIX index. So this meaning these ups are not a good thing really for the stock market. This is moving opposite of the market normally. These are kind of like the height of the volatility or the fear, as you will, with the VIX. The interesting thing about this chart to show you, so one, we're seeing it's downtrend. So it's a series of lower lows, okay? That normally means that's good. So if that's series of lower lows, you're hitting these ceilings and it keeps going lower and lower. It should mean the market is on its way, turning back around, going the other direction. So that's one way to look at this chart. The interesting thing though about this chart to point out is normally in high volatility and high areas of fear, which we have really felt this year, this is normally hits above 40. And so we don't normally even look at the VIX all too much or think we've hit a bottom until this VIX has hit above 40, which it has not during any of this time period. So that is something interesting to look at and think about. We could see, like I said, not base case, to hit a new low. I'll talk about that more, but if we do move into recession, if we did hit a new low, maybe you'd finally see this VIX hit 40. And then, like I said, quick turnaround from there. That's a possibility. So I want to, just because I'm getting so many questions on this right now, my recession base case. So mine meaning people that I follow, LPL research, and the people that I like to listen to. So the other experts that are not myself that follow this and charts and everything just more closely on the economy. So most professionals and leading indicators are leaning towards a mild recession toward the end of the year. We've all been hearing about it. Many people were like, hey, but then we did that last year. Like, shouldn't recession have been last year? In the past, we have seen stocks rise after recessions have started, since stock markets are looking forward. So I've been explaining this to clients recently in phone calls, but I want to teach you guys this here too. So the stock market is a forward-facing thing. It is always looking out into the future, which means that right now, it's trying to gauge if we're going to hit a recession. So that's why you see all this volatility. It's taking in Fed interest rates. It's taking in banking crisis. It's taking in just all these things, debt ceiling now, all these other things going on. And it's looking out into the future of like, what do those mean for the economy going forward, right? So that's where you see stock market volatility normally going into a recession. After a recession has started, now the stocks go, okay, great. The market, who likes certainty and hates uncertainty, says, perfect. Now we've hit the recession and we know the recession is going to end. So it actually starts going back up before recessions are even over. LPL research base case is that a recession will not cause new lows. So we might, hopefully we'll stick to those October lows of last year, because they really do believe that most of this recession has already been priced in. It has been the most anticipated recession since 1937. So pretty much everyone knows this recession is coming. A lot of people feel like it's already been here. We'll talk about that in a second, but it's been the most anticipated recession since 1937. So they believe that, again, stock market is looking forward, that it's already priced in a recession, a mild recession towards the end of the year. And we won't see new lows, but we will still have volatility until that happens. And then once that recession hits, we can finally turn back the other way. If, again, like I said in the previous slide, if new lows are hit, many see a very swift stock market recovery once we get this recession out of the way. So it's just getting into that recession and getting that recession over with, and then swift recovery the other way. So it is not a time to go to cash. You do not want to be going to cash heading into this recession. And I mean selling investments and holding more cash. If you already have cash, there's a different strategy with there, but it's not a time to sell. One, because this is thought to be a very mild recession, okay? It will turn around quickly. And we've already hit most of that volatility, more than likely. Even if we hit new lows, they're not anticipated to be much lower than where they're at. Again, swift market recovery the other direction. You don't want to get out of markets the biggest days in the market come at the bottom. And if you sell and you miss those days, you're going to miss out on huge returns. A conversation I've had a lot with clients. So last year's decline was actually very typical recessionary bear market, which is interesting because we did not deem an official, government did not deem an official recession, though many people felt like, okay, we had 2 quarters of shrinking GDP. Isn't that a recession? Well, there were other things that weren't falling in line with that, like consumer spending and employment. Sorry, my brain wasn't working there for a second. So those 2 things didn't really fall in line with a typical recession, but the stock market actually acted like it was a typical recessionary bear market last year. So it's almost as if we've already, again, we've been anticipating this recession. The market's been acting like it's a recession anyways, which is why this base case that it's going to turn around real quickly and not hit a new low. Also, the reason it does turn around during recessions is the Fed would normally, once you get to recession, the Fed starts lowering rates again. So what is expected is you're going to have this rate hike again, probably this week, maybe next month, but then that one's obviously remains to be seen. But after that, most professionals believe that the Fed will stop. We'll kind of finish up the summer. If we hit a recession end of the year, then we'll eventually start seeing those rates get lowered again. So this was on the last one, but just because there's new people and to kind of keep working it in there, how to prepare for a recession. So since it is the most anticipated recession since 1937, you have time to prepare. Make sure your emergency fund is correctly funded and accessible. Maybe considering adding a few more months worth of savings to it if you're just super worried about it. But make sure your emergency fund is accessible and funded. Correctly funded would mean what you need to live on times the amount of months you want. So like if you have $5,000 expenses in your month, and you have a steady job, you could do 3 months and have $15,000 saved in your emergency fund. If you are an entrepreneur, if you are commission-based, in sales, maybe consider going longer than 3 months, go 6 months, maybe 6 to 9 months, of emergency fund, just because your work looks a little bit different. Budgeting, do a budget refresh. We're talking about budget today. So you can get a chance to do a budget refresh, maybe cut or flag some expenses you'd be willing to cut if and when a recession happens. Extra income, look for other ways to provide income in case of a layoff or just for a side hustle for more flexibility and more cash flow. And then cash and investing in recessions are full of opportunities. So it can be helpful to have extra cash on hand to take advantage, whether that's real estate, share prices, or larger purchases, like even a car. Like if you have some needs coming up, save for those, because recession, everything goes on sale. So let's get into budgeting. Dave Ramsey always says a budget is telling your money where to go instead of wondering where it went. That is important. You want to know exactly where it is. Otherwise, it will be gone and you'll be like, where did it go? So don't hold me to these exact numbers on this slide. Budgeting it's not what you make. It is how you manage, okay? So again, don't hold me to these exact numbers. This is, probably not perfectly accurate, but what it is showing you is that these people made a lot of money. And they're not worth very much for how much they made. They did not manage their money well. A lot of people, when it comes to budgeting or saving or investing, say mentally, maybe not out loud, but mentally, it's like, when I make more, when I get that check, when I get that bonus, then I will. That is a bad way to look at it, because it won't be like that. You'll have lifestyle creep. You'll get excited. You want to be flashy with your money, all these things, and then it's gone. So these people, so Mike Tyson, he earned $700 million. And apparently is thought to be only worth about 3 million. Lindsay Lohan earned 28 million, apparently thought to be worth only 800,000. Seems, I don't know, shockingly low for how much she's earned, but regardless, she's worth a lot less than she's earned. Dennis Rodman earned 27 million, worth 500,000. Again, don't quote me on these exact numbers. But these people did not manage their money well and are worth significantly less than what they should be. So how to budget. So let's go through what I would do, or what I do with clients when they want to do a budget. I always like to have people start by just writing down on a piece of paper what they think their income and expenses are. Most people think they can mentally track their budget and they have an idea of what their expenses are, and that's great. And that's what they do. They do like a mental budget, right? So I want everyone to get their mental budget on paper. Write down what you think your expenses are off the top of your head. Okay. And then you're going to find a budgeting software. Like EveryDollar is a great one. Mint's okay. Or eMoney. That's what my clients use, is eMoney. So if you are a client and you want to, make sure if you have access to that, eMoney has good budgeting software. Then you're going to aggregate all your cards and all your bank accounts to the software. And within these, obviously, budgeting software, you set your budget. So set your budget that you wrote on your piece of paper. So right now, what you think your budget is, aggregate your cards. So all your spending is going to be tracked there, and put up what you think your budget is in the software. Okay. Then you're going to go through the very tedious but necessary task of categorizing and labeling spending on the software. So a lot of times this is going to be really hard the first couple of months because it's just getting used to your spending. But a lot of times you can like set rules and make sure that every time you go to Starbucks, it says it's coffee, or every time you go to Trader Joe's, it says it's the grocery store, for example. So make sure you categorize and label all your spending on your software. Take your time to that. Okay. So that was step number 4. Step number 5, you're going to spend the next 3 months fine-tuning your budget and adjusting where needed. Okay. You will find, anybody who thinks they do a mental budget will find that your mental budget is not accurate at all. So you will be adjusting your budget. And from my experience, it takes at least 3 months to really dial in your budget. So the first month, you've had your budget from your piece of paper that you've put on your software, you've done your spending, and you're going to see, okay, wow, I was way off. I thought we spent $1,000 on food. We do not. We spend $1,500. I thought we spend this much on gas. We do not. We spend this much. So you're going to need to adjust. Part of adjusting is 2 things. It's saving money. So look where you can save money. Like I said, step number 6, review spending and cut. Like, can you cut insurance? Can you switch insurance and cut? Can you cut subscription you're not using? Food is a huge place that you can normally cut. So that's part of the adjusting, is looking for places to cut. And then the other part of adjusting is looking for things to be realistic on. So, okay, it's not realistic for our family and to feed everybody in our family for this much money. Like, we do need to make that more expensive. We're never going to hit that, no matter how many coupons we clip. So we need to make this much money. So it kind of goes 2 ways. It's 2-sided, like I said. So being realistic in certain areas, but also looking for opportunities and ways to cut. After 3 months, so this is going to be, it will be a big task. It's going to be a big job for a 3-month period. You're going to be reviewing it. You're going to be looking at it. You're going to be adjusting. After you commit to 3 months on this, you will know what your surplus is, and you can begin applying it towards different goals. So you'll know, okay, what goes out is $4,000. What comes in is $5,000. We've really dialed that in. We know that's accurate. We know that's consistent. So now we can look at where that surplus is going to go, and we can begin applying that again towards your different goals. And then from there, you're going to continue to keep that budget on the software, and you are going to review every month. It's much quicker. It's much easier. It's once a month, looking at it, maybe twice a month, maybe at the beginning, maybe at the end, whatever cadence ends up working for you. But the first 3 months are a big onboarding, and then it gets easier because you have it dialed in. If you do not continue to review and keep tabs on it, you will incur lifestyle creep. We all do. You slowly start spending more on food again. You slowly start spending more on eating out again. And you slowly start spending more on shopping again. It's what happens. So you need to keep just eyes on it and tabs on it to make sure that your surplus stays your surplus. Okay. So once you have a budget, once you've gone through that, then I want you to do a few things. So it's all dialed in. You've done your 3 months, maybe a few extra months of review. Here's what I want you to do next. I want you to automate as much as possible. Automate your bills around when you get paid. If you get paid in the beginning of the month, great. Get a lot of those bills out in the beginning of the month. And 2, pay yourself first in the beginning of the month. So when I say pay yourself first, I mean, whatever those surplus goals of yours were, whatever those are being applying towards, that extra cash flow, that the extra money that you have, it's not extra, now it's like planned for. Get that out of there first, pay yourself first, invest it into your Roth IRA, get it into your emergency fund, get it towards your debt payment, whatever it's doing, pay yourself first. Then you're going to work towards a 20-25% savings rate. Once you have a budget, that's what I want your next goal to be. And then, like I said, you're going to review monthly to keep tabs on that lifestyle creep. And you're going to use sinking funds to save for once a year expenses. So as you've budgeted, and that's why another reason we do 3 months, because we all know that it's like there's certain months that have like a one-time cost, right? Christmas, for example, or maybe you pay a life insurance policy once a year, or you go on a trip a couple times a year, but it just happens in those months. Instead of paying for it in that month that you're doing it, save for it the entire year. So the money is already there when you get to that month. Okay. So those are sinking funds. Set up extra funds for expenses that are expected. Basically, once you know we're coming, you know, you're going to take that trip, start saving for it. And it creates so much freedom, because then by the time you get to that trip, you've already have the money set aside. You're not having to put it on a credit card. You're not having to deal with it and try to figure it into your monthly budget. You have the money. It creates more freedom. So that is what I want you to work on those 5 steps once you have a budget. Here's just an example. I want to show you a client's budget that I've helped them with. Obviously, this is, I'm not going to tell you who this is, but you can see here that every month the red has gotten a little bit better. Still working through some close things that are a tiny bit over, but it's gotten better. So this is how when I work with clients, they aggregate it on their software, and then we also do a spreadsheet, because I love spreadsheets. But you're going to do, so this was their, last year's budget. Everything listed here, this is what they thought their budget was going to be, and this is what they actually spent. Okay, so then we can adjust, right? They had a problem. They were 700 negative. Okay, so then we adjusted some things. Some things went up. You'll see car gas. They're next to be 250. Gas was going up last year, obviously, by a lot. So we raised it to 375. Maybe, this seemed like a little bit high. Maybe we can drive less than that, right? Food budget. $1,000 was not going to be, with inflation, was not going to work out for them. They had to move it. Have some kids. Kids sports was a weird one for them. Kids, like, sometimes they hit, sometimes they don't. Kids like activities. So we figured out eventually they wanted just the budget $200 a month for that, and just put that in the sinking fund. So it was there, and their kids could do activity. They like to give to their church, and so that is in there. Their savings in here, other investments. So they were kind of still replenishing emergency fund, but they also wanted to kind of get some retirement stuff going there. Shopping, gifts, etc. So it did, like I said, just showing you here, it took about 3 months of adjusting what, here's what they thought they were going to spend. Here's what then they adjusted here, but they still had some issues. So every month kind of figuring it out until it really made more sense. And look, they had to increase income and get a side hustle to make a little bit more money, to give themselves a little bit more cushion in both areas. So that was something that they did. So my budgeting tips for you is, 1, stay dedicated. The first few months of budgeting are the hardest. It's frustrating and annoying, and it feels like, okay, I'm just limiting myself on where I can spend my money. It's not that. It feels like it's limiting you. It will give you freedom. Okay. Accountability. It might be helpful to have an outside set of eyes helping you, especially in the beginning, and mediating maybe between you and your spouse if you have some conflict, or just trying to figure out where the best place to spend your money. So think about that if you need accountability, and then look for opportunity. Whether it's cutting spending or increasing your income, look for other opportunities, ways to maximize your budgeting. And then, like I said, once you finally, you have to stay dedicated in that beginning time period, because it is hard to get it under control. But once you do, you will be able to enjoy the freedom out of it. You will see the freedom once you get past those first few months. And you'll begin seeing the freedom that budgeting brings. This would be my order of priority for you for surplus. So like I said, once you have that dialed in, you know what extra cash flow you have, extra money you have. And then now that extra is not extra, once you get past those first 3 months, now that's what you're paying yourself first, and working towards that 20-25% savings rate. Debt payoff is number 1. So especially high interest debt. I'm not talking about your house here, but I am talking about other debt besides your house. Look for, that making that a priority for your debt payoff. If you have credit card debt and student loans. Then you're going to do your emergency fund. We already mentioned in the beginning, that is 3 to 6 months of expenses saved, and possibly more depending if you're maybe an entrepreneur or a commission-based, some real estate agent, for example. After that, once you have that settled in, I would say, kind of a house down payment, and these don't have to be exactly one at a time. You might have to save for a house down payment and also start saving for retirement. Retirement, you're going to want to get to a goal of saving about 15% of your income toward retirement. And then once you kind of hit that, you got your retirement going, 50% in towards your retirement, and then the rest of that 20 or 25% towards other short-term savings or possible long-term savings too, in different ways. Maybe not all in a retirement account though. So, like I said, it's always part of our goal to talk about how to become a more confident investor. And so, again, one of these slides that will always be on here is steps to being confidence through the process here with Selah. So it always starts with that comprehensive needs analysis, working then towards that custom solution, and then accountability and implementation along the way, depending on what goals that you have, and then continual refinement. So planning, financial planning is not like a one-time thing and you have it set and you're good. Life is always changing, your finances are always changing, and so there's that continual refinement as part of our relationship. And just had to put in these disclosures here just about LPL Financial. And finally, ways that you can get in touch and stay educated. Always a confident investor is an educated investor. I do my best to put out different videos, and I do podcasts. And again, this webinar just for you to stay educated on the markets and other behavioral financial topics. So please find me on those platforms there. And thank you for joining today. I will, you'll get a reminder about next month's webinar, and then I'll get you out the replay as well. So you have that if that is something you're interested in sharing, or just any information that you wanted to review. So thanks for being on here. Looking forward to next time.